Wanted to take a few minutes and talk about these new rules that were just announced, big changes to Canada's mortgage rules. These were announced by Finance Minister Chrystia Freeland. And these are changes that I'm not so convinced are going to be, for the long term of Canadians building wealth, are going to be good. But let's talk about the pros and cons today. They are supposed to make home ownership more accessible to younger people, to first-time home buyers. They're designed to address the housing affordability challenges that we have here in Canada. And there's no question that we have those. Some of the keys, or the two keys that they're doing in the announcement yesterday. First off, they include raising the price cap for insured mortgages. I want to explain that in just a minute here. And also they're extending the amortization period. This video today, I'm just going to cover off these two new rules. I want to compare them to the existing rules and then have a look at the potential economic, financial implications. And also, I think that there might be some political motivations behind these as well. So let's break those down here. From these sectors, first off, the key mortgage rule changes that we saw introduced, there's two main rules. The primary adjustments are this. For the price cap for insured mortgages, this is going to go up to $1.5 million from the current $1 million. This will allow more buyers access to mortgage insurance for a down payment of less than 20%. Cover that off in detail in just a second. The second big change is the 30-year mortgage amortization option. You could get this before if you were a first-time home buyer and were purchasing a newly built home. That was available. But with this change now, that'll be available to all first-time home buyers and anyone purchasing a newly constructed home. So that's the change there. Now, when we look at this cap, this is probably the lesser of the two evils, I think, but it's still, I see some cons here. We'll talk about those in detail here. Under the new rule, the price cap for insured mortgages is being raised to $1.5 million. So what this means is that if you're looking to purchase a home between $1 million and $1.5 million, you can now qualify for mortgage insurance with a down payment of less than 20%. Now, as an example, under the old rule, if you were buying a home that was valued at $1.2 million, you would need to put at least 20% down. So that's $240,000 you'd have to come up with just to get started on that. Now, with the new rule, the same buyer could put down much less. You could put down as little as 5%. That depends on the mortgage terms, but that's possible. And the mortgage would still qualify for insurance. Now, obviously here, with this lower down payment requirement, it makes these higher priced homes more accessible, especially in some of the really hot real estate markets. And you think Toronto, you think Vancouver, probably Montreal as well. But there are some real potential trade-offs here. Yes, this makes it easier for you to get into the market with that less cash. But a smaller down payment, that of course is going to mean that the mortgage amount is higher. So you're going to have larger monthly payments than you would otherwise have. Buyers with smaller down payments, you must pay these mortgage insurance premiums. The good thing is you can get the mortgage insurance. The bad thing is you're going to have those premiums. That is going to increase the total cost of your mortgage over time. Also, you will be taking on a higher debt load if you purchase these more expensive homes with a smaller down payment. That could make them home buyers obviously more vulnerable to future interest rate hikes, or if you run into financial difficulties. We've seen that over the last few years where people who had a smaller down payment ran into a lot of trouble when interest rates arose. The impact that this will have on the overall market, that's another concern. By raising this mortgage cap, obviously more and more buyers are going to be entering the market. That will no doubt increase the demand for those houses that are priced between $1 million and $1.5 million. There are a lot of those houses out there. So this will definitely benefit buyers in the short term. It'll allow you to get into it in the short term, but it could lead, I think it will lead to higher home prices in the long run. Obviously increased demand, that's going to put upward pressure on the prices. Because of this, when I'm looking at the news out there today, there's a lot of economists and they're sharing their concerns about the future inflation of housing prices. And in a nutshell here, I'm going to call this policy double-edged, right? It opens up more housing, definitely more options for buyers, but it also carries that risk of increased debt and higher home prices in already expensive markets. That's one thing. Now, the second part of this, the second big part, is that it allows people to take mortgages for 30 years rather than sort of the more traditional 25 years. This is the part that concerns me the most when it comes to a wealth building perspective. Under the old rule, 30-year mortgages were available, but only to first-time buyers of newly built homes. So under the new changes now, this 30-year amortization is an option that will be extended to all first-time buyers and to all buyers of new home. So let's talk about the pros of this first. Let's be fair. As I mentioned, this will result in lower monthly payments. So with that longer amortization period, the loan is spread out over a greater number of years. That will result in lower monthly mortgage payments. That makes homeownership more affordable in the short term. Again, targeting the younger group, especially for those first-time buyers, those with lower incomes. So that's a positive. It does increase housing accessibility. We've talked so much on this channel and just in general about the fact that a lot of younger people can't afford houses in the first place. So obviously with lower monthly payments here, it can make it easier for buyers to qualify for mortgages. Again, especially in those higher price markets like Toronto, Vancouver, where housing affordability is definitely a major issue. It provides greater financial flexibility. So if you have a mortgage that's the lower monthly obligation, you will have more disposable income, probably. All else being equal, that will allow you to continue perhaps with a savings program, investment program that could improve the overall financial flexibility of a person. Now, the cons of this amortization period extension. First of all, the biggest thing is it's going to result in overall higher costs. So the monthly payments are going to be lower, yes, but the total amount that you will pay over the life of the loan is a lot higher compared to the shorter amortization periods, and I'll just say compared to the 25-year. You're going to end up paying significantly more in interest over that 30-year term. That increases the overall cost of the home. That's not a good thing. Another reason people buy homes is to build up equity, and clearly with these longer amortization periods, less of each monthly payment is going to be going towards the principal, especially in those earlier years of the mortgage. That is going to result in slower equity buildup. Homeowners are going to take a lot longer with this new program to build any kind of substantial portion of their home that they own themselves. A higher debt burden. I really see a problem here. A lot of people might be encouraged to take on more debt than they might otherwise, and this could lead them to purchase homes that are more expensive than they actually can afford. This is going to be controversial because the realtors are going to be wanting to sell these houses, of course, but you got to be careful you don't stretch yourself too thin. And this could make a lot of people more vulnerable to economic shocks. Again, I mentioned this earlier, interest rate hikes or any major personal financial setbacks. We always have to prepare for that. So we can't spread ourselves too thin. Another point here is the potential impact on the housing prices. This extension of amortization, it could lead, I think it will lead to higher home demand. That will be a given there. But also it'll make homes less affordable. This will drive up home prices, I guess is what I'm trying to say here, especially in these hot markets. That will only make housing affordability crisis worse in the long run, and it will put increased pressure on prices there. A fifth point I wanted to just share here is there will be greater exposure to interest rate risk. Again, if you've been, for example, on a variable rate mortgage over the last number of years, you'll know exactly what I'm talking about here. The monthly payments under this new scheme, they could be more manageable initially. Homeowners with small payments and longer amortization periods, though, you're going to be more exposed to interest rate fluctuations. And if we see, or when we see another period where these interest rates rise during the term of a mortgage, this one will be fixed on these ones here. But say a 5-year mortgage, when that's gone there, you still have a high mortgage. With a variable rate mortgage, you could face a lot of financial stress in the future. Now, I'm not an overly political person, but I am a bit cynical here. I think I probably am joining a pretty big crowd here of the political motivations behind these changes. Now, the Trudeau government, obviously, there has been a lot of sustained criticism that they have faced over the handling of the housing affordability crisis that we're all going through here in Canada. These housing prices, they've risen so much. The high interest rates that we've gone through have made homeownership very difficult. Again, especially getting back to that younger Canadian group. Polls are showing recently that the Liberals have lost a significant amount of support from millennials, Gen Z. And I can't but wonder, is this prompting some of the reforms? Freeland calls this the boldest mortgage reforms in decades. And the government here, I think, is just sort of making a good effort to re-engage the younger voters to fight off these political pressures from opposition leaders. We've heard Conservative Party, Pierre Poilievre, speak on this issue a lot. So I think that we're seeing these changes, and we have an election coming up pretty soon. And again, call me skeptical, but I'm seeing these changes as a very timely effort to win back this key demographic, well, it does address some concerns in the short term over housing affordability. Now, I wanted to look at sort of three different viewpoints here, depending on which side of the table you're sitting on. First of all, if you are a prospective home buyer, probably you're going to welcome these changes. They all sound like a very good thing. They offer an immediate solution. If you've been struggling to create enough of a down payment, this will ease that. But as I mentioned, you need to consider the longer term costs of the higher interest payments over the life of a 30-year mortgage. Pros and cons. From a real estate perspective, yeah, again, the increased mortgage cap that we see, that's going to open the doors for a lot more buyers. It'll make housing more affordable in the short term. But a lot of real estate experts that I've been reading about this morning, they're arguing that these changes may lead to higher home prices. I think that they will lead to higher home prices by increasing that competition in an already stretched market there. I think the policy, again, is a short-term fix that just sort of fails to address the broader issue of the housing supply. It's not going to help us there at all. And the third perspective here, if you are looking at this from an economist's perspective, and we're dealing with this housing problem, these housing changes, the housing policies, I think will just make worse the affordability in the long term. Yes, immediate relief will see that, but there is also this risk of inflating the demand and pushing housing prices even higher. Then what will that do? Well, it could deepen this affordability crisis that we've been going through, especially with new homes, the supply of new homes remaining relatively limited. Definitely, there's some pros and cons here. For me, the cons outweigh the pros. I love home ownership. It's a great way to create wealth, but it's also a very slippery slope. And I see these changes taking us right to the edge of that slippery slope. As always, thank you for taking the time to watch the video. We'll see you next time.